to the first thing that you may have never known. And that is, hopefully, you know, if you are on our Bobcast very often, but the current events effects on the market are usually temporary and overblown. So you see stories on the news all the time, or maybe when you're talking with friends, having coffee or something like that, you hear about, oh, well, this is going on and this could really, you know, crash the stock market. And it could be any number of things, but usually there's something that's always going on that people would look at as maybe a threat to the stock market. And so we wanted to go through and just show for perspective the historical performance of the S&P 500 during several major current events. And the first one being presidential election years. So
yeah, because we're in a presidential election year.
This is a chart of the S&P 500 and the average returns during election years and non-election years since 1932. The non-election years are in dark blue, election years are in light blue. And as you can see, what the actual performance tends to be during a presidential election year is a little bit less than the average of a non-election year, but not by much. So the average of the S&P 500 during non-election years is about 10.5%, and the average performance of the S&P 500 during presidential election years is about 7.5%. And most important thing to note is that there's typically in presidential election years more volatility during the first part of the year that slows down. The volatility in maybe possible market dips, things like that, typically slow down a little bit after the primaries. So that's something to note. So a lot of people think, oh my gosh, it's a presidential election year, the market is just gonna go crazy, or it's just gonna be terrible. And the truth is, actually, over all the history of our presidential elections since the S&P 500 has been established as a market index, 83% of the time, the S&P 500 has a positive return during a presidential election year.
One thing I will note, you know, this time period where it says that it's typically stagnant in the market, right now, as of today, the stock market is up around a little bit over 10% since the beginning of the year. So we've, you know, outperformed the typical election year already. And the reason for that is that these companies are making money. Not all of them, but most large companies, most publicly held companies are increasing their earnings and are doing quite well. And that's what the ultimate value of a stock is. And so we believe the earnings are going to continue to stay there and continue to increase, barring some drastic government taxes or regulations or stuff like that that we're going to talk about a little bit later. So we're very bullish on the stock markets right now.
Yeah, and speaking of like presidential election cycles and the stock market, we talked about this back when there was midterm elections. Midterm election years are much more volatile, and usually a stock market has a hard time during a midterm election year. On average, but presidential election years do much better. So
yeah,
it's not really what you would expect. That's why it's kind of a mystery, but
that's why it's a mystery.
That's how it goes. Okay. So let me get here. How'd I get out of that? Sorry.
I don't know.
Technical difficulties, stand by. Okay. All right.
Next slide. Next slide.
The next thing we're going to talk about is how the stock market, again, we're using the S&P 500, reacts to war or world conflicts. Okay, so this is a chart that we used back when Russia invaded Ukraine, because everybody was freaking out about the stock market, and the stock market took a temporary bump. Typically, what happens when there is a world conflict or potential war, a war starting anywhere in the world, is that the stock market will take a temporary dip because there's so much uncertainty and people are fearful about how is this going to affect the United States, how, you know, what the wide-ranging effects of the conflict might be. And then people usually calm down and the stock market usually goes back up again. It's usually just a very temporary, short-lived thing. And actually, overall, if you look at the performance of the stock market during war times, it performs slightly better than it does during non-war times.
And
So
what causes these dips is it's fear. And not everybody, but some people, when they get, they hear the news and the news is doing what the news does, fear mongering about an impending war. Some people make investment decisions based on the emotion of fear and sell. And when you have more than normal people selling, the market dips. And then they figure out that the world isn't going to come to an end and the market goes back up and actually, like Jesse said, typically does a little bit better during wartime periods than non-wartime periods.
And all of this is brought up because of what's going on in the Middle East right now with Israel.
Right.
So, okay. And the next current event type situation that might be something you don't expect is how the stock market performs during recessions. And this is kind of a busy chart, so I'm just going to try to summarize it the best that I can. But these are all the recessions since 1953, including 2020. And it has how long they lasted and what the stock market did during the recession, a little bit before and after the recession. Okay, so what's really interesting to note to me is that if you look at what the stock market does during recession on all these columns, the average return during recession is minus 1%. The amount of time a recession lasts is very short,
Usually less than a year.
2 recessions. And the thing about people fearing how the stock market's going to perform during a recession is I think because they have this recession and the financial crisis still in their minds because it was not that long ago. And it was the worst one. And it was the most severe. But if you average out all of the rest of these, the stock market doesn't even have a negative return in a lot of them. If you took this one out of the picture, we wouldn't even have a negative average return.
Yep.
And then if you look at, 45% of the time, even with this one, the stock market has a positive return. And if you look at these average returns down here of how the stock market does before and after the recession ends, the stock market does worse in the months leading up to the recession than it actually does during the recession. And then look how well it rebounds in the months after the recession. So a recession is not a death penalty for the stock market or necessarily something to be super afraid of with the stock market. All right, and then the last thing is how the stock market performs during interest rate period hikes, like we're in right now. Okay, so this is up till now, all of the interest rate hike periods, looks like since 1954. The S&P performed at an average annual rate of 9.4% during these rate hike cycles, which is very close to what its regular average return of about 10.5% is. There's only one period actually where it was negative. And so these interest rate hike periods are not bad for the stock market either. And a lot of times that's because when interest rates are being increased, it's because the Fed is trying to fight inflation. And inflation is typically something that is good for the stock market in the short term.
Yes. Yes. So, and right now what we're experiencing with this inflation, and it's just going to get worse, is because of all the money that the government printed over the last 3 or 4 years. And they've increased the number of dollars in the world financial system by 40%, inevitably causing sky-high inflation that's going to keep getting worse. And the result of inflation, or the next consequence of that high inflation, is increased interest rates. We've seen increased interest rates over the last couple of years. There's a pause right now by the government. It's a pause because it's an election year. After the election, the presidential election, they will, I'm confident, continue to raise interest rates. And we're going to experience, we believe, the same thing that happened in the late 70s and early 80s with inflation and high interest rates, and also what the stock market did. What the stock market did in the highest 5 years of inflation from 78 until 83, most of you watching this webinar were around like I was then. Jesse wasn't around at all. But anyway, was that the stock market outperformed its average. Stock market did 16.5% per year during those 5 years of highest inflation. And so.
Yeah, and so part of why we bring this up is that every time there's a Fed meeting and interest rates, whether they're going to raise them or hold them or lower them, are being talked about, the stock market goes a little bit crazy if you haven't already noticed. And you're going to hear a bunch of different news stories on, oh, the stock market's going down because the Fed decided to raise interest rates, or it's basically there's just going to be crazy news stories around.
And the people
every single time.
The people that are writing the news stories are not financial experts. They're journalism. They have journalism degrees. Their job is to keep you to continue to watch the news. That's what their job is, to keep your eyes on the paper, keep your eyes on the news, keep your ears listening to the radio. They're not financial experts like Jesse and I are, and they're not professional financial advisors. So don't fall for the hype.